It's been a difficult period. It has lasted a lot longer than anybody anticipated, including central banks themselves. I don't think central banks believed that we would be stuck in this low level of interest rates for such a long time. And of course, it's a difficult period for anybody who makes long-term promises, because their ability to meet these long-term promises without taking excessive risks is much reduced. So two things have happened. One is a migration down of these long-term promises, and two is a narrowing of the opportunities that are available. Who suffers most? Those looking for long-term financial security. So savers who are willing to lock up their capital in safe assets, which is normally government bonds, and of course people who look to providers of life insurance. So it's a difficult period. It's gone on for a lot longer than anybody anticipated, and it is likely to go on for a while with an important qualification, which is we're going to see more dispersion and we're going to see more volatility. The hope is that low policy rates encourage people to take more financial risk, which pushes up asset prices, which makes people feel richer, and that then triggers what's called the wealth effect. People spend more, which encourages companies to invest more. And next thing you know, the higher financial assets are validated by higher fundamentals. It's a hope, not an expectation. And the reason why it's a hope is because the fundamentals are dragged down by some very consequential structural issues. Issues of over-indebtedness, insufficient investment in infrastructure, in the reform of the labor market, of corporate taxation. In addition, we have a mismatch of aggregate demand, and we have an incomplete financial architecture. So the hope is that somehow the higher prices are validated by fundamentals. They pull the fundamentals up. But the reality is that that's very difficult. And that the big question becomes, when we look back on this, will we look back at this as a period of hope, or will we look back at this as a period in which we couldn't sustain ultimately the financial assets, and the financial assets come down and then crush the fundamentals? The answer to which of the two will prevail is not, I stress, not in the hands of central banks. It's in the hands of other policymakers, those who can directly address what ails economic fundamentals. And it's a question of whether politicians will finally be able to get the act together to supplement what central banks have and deliver what we really need, which is a comprehensive policy response. When you look at emerging markets, the first thing you conclude is that it's really tough for them to operate in the current global environment. The current global environment is constructed on the assumption that the core of the system, the advanced economies, are stable and responsible, and that the volatility happens at the periphery of the system. But what's actually happening is that the core of the system has been experimenting with various policies, QE, zero interest rates, and as a result, it has transmitted all sorts of disruptions to the periphery of the system. And if you're in the periphery of the system, you don't have the institutions that are strong enough to navigate through this. So this is an inherently difficult time for the emerging world. The one thing that you'll hear policymakers in the emerging world tell their counterpart in the developed world, just make up your mind and get going. That part of the problem we have is the uncertainty of how the core is behaving. So the greater certainty you can provide the system, the more we know how to manage our own affairs. So there's a line of argument that says at the end of the day, it may well be that higher interest rates may be a good thing for the emerging world, because they'll take away the uncertainty and they'll take away these high volatility flows in and out of these countries that respond to interest rate prospects. I think ultimately, the big question is, why do interest rates go up? If interest rates go up because the advanced economies are finally getting economic traction, then that's a good thing in the emerging world. If, however, interest rates go up in the advanced world because risks are going up, then that will be a much worse world for the emerging countries. So in my mind, the biggest unknown, and it speaks to lots of economic, social, political, and geopolitical issues, is will the quest for high and inclusive growth be successful? The biggest challenge facing the global economy, and therefore the biggest challenge facing investors, is the ability to promote high and inclusive growth. In most parts of the world, this means evolving your growth model. It means doing some fundamental engineering and some fundamental structural work. So far, this quest for growth has been frustrating. The ability to grow inclusively has been elusive for too many countries. And the biggest uncertainty is whether the political system will be able to respond and will be able to deliver the sorts of changes that are needed to promote high and inclusive growth, or alternatively, it fails to respond, and then we not just have low growth, but we have the return of financial instability.